Hello students, now let us discuss the next topic, foreign financial reporting. Very important for your exams, MCQs will come. So foreign financial reporting is basically divided into two. One is under Banking Secrecy Act. Another one is your FATCA, Foreign Account Tax Compliance Act. So any US citizen or US resident, legal resident like green card holders, etc., they have to do foreign financial reporting. Basically means foreign bank accounts, foreign security accounts, gold, bullion, etc. Under these two acts, under Banking Secrecy Act, they have to file a form, something called FBAR. So you might have heard about FBAR reporting. It means foreign bank accounts and financial accounting reporting. So there are specific limits for this, we will discuss that. Under FATCA, you have to file a form called Form 8938. This will be filed along with your Form 1040, which is your individual tax return. There are also limits for this, we will discuss. So entire your foreign financial reporting depends on these two acts. Normally your Banking Secrecy Act is under Financial Crimes Enforcement Network. Okay, but IRS administers it. So whatever filing you are doing FBAR, this is FinCEN form 114. This form you will submit to Financial Crimes Enforcement Network, but the administration, penalties, everything will be done by IRS. This is part of your Treasury Department, US Treasury. IRS is also part of US Treasury. This form 8938 is directly submitted to IRS along with your income tax return. Okay, now who should file FBAR? If you have any financial accounts, FBAR, FinCEN form 114. Okay, form 114. Who has to do this? Any US citizen or US legal resident having financial accounts outside US with amount greater than 10,000 US dollars at any point in the tax year. For these persons, they have to compulsory file FBAR FinCEN form 114. This is the limit. Now coming to what will be treated as your financial accounts. Financial accounts. Your bank account will be treated as your financial account. If you have any foreign brokerage account, your demat account, etc. Basically, so in India we call demat account, these are security accounts. Okay, mutual fund accounts, insurance policies. If value of any of these exceeds, any of these are put together exceeds 10,000 US dollars, you have to file FinCEN form 114 FBAR report. Gold, bullion, silver held with financial institution. So basically your foreign financial institution. Example. So what happens is in US citizens normally purchase gold bars, silver bars as an investment, and they will keep in a locker. So this is basically done in Switzerland and all. Switzerland has specific lockers where they store your bullion, gold, silver, etc. And when the gold price reaches a certain point of return, they will sell these gold bars. Even that you have to report under FBAR. So I think you understood this form, FinCEN form 114. What happens if you don't file your FBAR report? Then IRS will levy penalty The penalty is for non-willful filing $16,536. So you don't know that you should file your FBAR report, and it is a non-willful, then IRS can levy penalty up to $16,536. This penalty is per report. Previously what used to happen is some courts used to levy penalty per financial account. It means, let's say for 2025 tax year you have 5 foreign accounts, foreign bank accounts in different countries. Even though you have 5 foreign bank accounts, you have to file only one FBAR report. So what courts used to do is they used to levy penalty 5 into $16,536. So which is approximately 90,000. Okay, but Supreme Court in the latest judgment clarified that this penalty is applicable per report. It is not per financial account, not per bank account. Remember, Supreme Court judgment, very important for your exams. Court judgment, the penalty is per FBAR report. Okay, so that is your FinCEN form 114, which is under Banking Secrecy Act. Now let us discuss about form 8938, which comes under FATCA. So here also you have to report your foreign financial accounts. This is filed along with your form 1040, which is your individual income tax return. Now you may get doubt whether I have to file both FBAR and form 8938. Yes, if the limit crosses 10,000, then you have to file FBAR, and the limit we'll discuss for form 8938. The limit for single person is $50,000 at the end of the tax year if he has balance of $50,000, or $75,000 at any point in the tax year. For single status person, this is the limit. If it crosses this limit, then you have to file form 8939. Okay, if it is crossing this limit, okay, it automatically crosses $10,000, then you have to file FBAR also. So 2 reports you have to file. Now there is another question, so which is famously asked in your MCQs. I am a low income category person, but I have a bank account in Switzerland which is more than 75,000, which is more than $50,000 at the end of the tax year. But as a low income group person, I am not required to file any return for this particular year. Whether I have to file form 8938? That is the question. If you are not filing your income tax return, there is no need to file no income tax return, no form 8938. No need to file your 8938 separately, because this is an attachment to your form 1040. Now another question. Okay, I'm not required to file income tax return. Whether I have to file FinCEN form 114, which is your FBAR report. Yes, you have to file, even though you are not filing your individual income tax return. Why? Because FinCEN form 114 is filed to Financial Crimes Enforcement Network, not your IRS. Okay, but administration is done by IRS. So remember, even though you are not required to file your individual income tax return, you have to still file a FBAR report if your limit process the $10,000. Okay, so both are similar, only a little bit difference. This is an attachment to your 1040. The difference is very important for your exams. Now what is the penalty? Penalty is $10,000. If you are not filing 8939, if you are required to file, then the penalty IRS can levy is $10,000. So this is related to your foreign financial accounts. There are some other foreign financial reporting which we have to discuss, which are important for your exams. We'll discuss that now. First one is your form 3520. This is for your foreign gifts or behests. Behest is also a gift. Okay, if the limit is $100,000, you have received any gift, any foreign gift from any estate, any foreign estate, more than $100,000, then you have to report in form 3520. How you will receive the gift? Let's say your grandparents are staying in UK. So in their will they have written that my house after my death should go to my grandson. So unfortunately they have expired, and the estate and the administrator who is distributing the estate informed you that this house is yours. So this is a gift from your grandmother or grandfather. So if the house value is more than $100,000, you have to report in form 3520 because it is a gift by foreign gift. And you may ask me whether this is taxable. This is not taxable, but there is a reporting requirement. Okay, you have to compulsory report it. Even if you have received cash gifts, gold, bullion, whatever it is from a foreign source, then you have to report in form 3520 all the US citizens, US residents. There is another report, another type of reporting which you have to do, that is form 5471. So this is for your foreign shareholding. So if you are holding more than 10% of any foreign shares, then you have to report in form 5471. Compulsory you have to report, 100% you have to report. If you are holding more than 10% of any foreign corporation shares, you have to report in 5471. Here the penalty is 5% of the per month for 3520, 5% per month, maximum of 25% of the gift value, the penalty, if you are not filing form 3520. Here the penalty is $10,000. Okay, remember the penalties, it will come for your exams. 5% per month of value of the gift. If you have received 1 million gift, 5% will be the penalty if you are not disclosing it, even though if it is not taxable. And maximum they can levy 25%. And if you are holding any foreign shares, IRS can levy penalty up to $10,000. $10,000. Okay, clear? So this is all about your foreign financial reporting. There is one more last reporting which you have to do along with your form 1040, which is your individual income tax return. Schedule B, part 3. So here reporting of foreign accounts. So in this is part of your form 1040. In schedule 3, if you are maintaining any foreign accounts, okay, even though the balance is very less, even if you are not coming in FBAR reporting 8938 etc., still you have to report in schedule B part 3, even though you are maintaining zero balance, that you are maintaining some foreign account. Let's say you are maintaining a Swiss account that you have to disclose in your form 1040. This is your disclosure requirement. So this is all about your financial reporting. Very crisp overall understanding. That is what I have discussed. Now we'll go to the last and final topic of your paper 1, which is your estate tax and gift tax. Now let us discuss about estates. Estate is nothing but a separate legal entity created upon death of a person. Suppose let's say Mr. X has died and Mr. X estate will be created upon his death. We call that as X estate. Mr. X has a will. In the will, he appointed an executor. Okay, so who will be taking care of his estate? If he doesn't have a will, no will, then court will appoint an administrator to take care of Mr. X estate. Whatever the language is, IRS call these posts, they both are them as personal representative. It means this person is responsible for any taxes owed to IRS because of estate. Okay, so what is the responsibility of personal representative? He will be liable for any taxes and for distribution of assets from the X estate. Now, once estate is created, we will be discussing only on taxation point of view. Okay, how the estate will be assets will be distributed or all, we are not discussing. Only from the taxation point of view we will discuss. Once estate is created, there are 3 obligations on the personal representative, whether executor or administrator. If there is a will, we call him as executor. If the court appoints, we call them as administrator. IRS call them as personal representative, whatever the name is. Okay, so there are 3 obligations. One is form 1040 final return of. So we are taking X as example, right? This is final return of Mr. X. That is the first obligation. Second is form 1041, which is X estate tax return. So I told you, no, estate is a separate legal entity created upon death. So even estate has to file its own return. That we call as form 1041. And the last one is estate return, which is form 706. Okay, estate return is form 706. Estate as an entity, if it is filing, it is form 1041, and the final return 1040. Final return will be filed as if Mr. X is alive. So you will take all the deductions, all the credits, and whatever it is, you will file in the, you will arrive at the income and pay tax. That is the final return of X. Due date is same April 15th, and extension if you want, you can take it. Form 1041 estate tax return. This is also, the due date is same April 15th. So in your book it will be given as 3 months, 4 months after the end of the financial, 4th month, 3rd month, 15th. Okay, so same date, April 15th. And what will be deduction allowed is funeral expenses. Okay, any administrative expenses, deductions, administrative expenses. So a state person, the personal representative will have salary, right? That expenses they can deduct. Any distributions if he made after estate, that can be deducted. If estate is earning any income, so sometimes what happens is the assets, the deceased person assets may be earning some interest income, dividend income, that will be treated as estate's income, and they will get the deductions of administrative expenses, okay, distributions, funeral expenses, etc., etc. And finally you arrive at the profit and pay tax. Next is estate return. This is applicable only if estate value is greater than 13.99 million. Only if estate value is more than 13.99 million, then the personal representative is liable to file estate tax return, form 706. So estate value, what will be the estate value? Estate value is value of all assets, fair market value, FMV of all the assets, movable or immovable, gold, jewelry, shares, immovable property, etc. So entire value will be treated as estate value. If that value is more than 13.99 million, then you have to file form 706. What is the due date? Due date is 9 months after the person's death. So within 9 months this return should be filed. 6 months extension is allowed. And what is the tax he has to pay? Estate tax is 18% to 40%. It is a progressive tax. So once your estate value crosses 13.99 million, so whatever excess is there, that will be taxed at the rate of 18 to 40% on a progressive basis. So that is your estate tax. So till 13.99 million, no need to pay any estate tax. So if you are inheriting something, or the person from your father or from your grandfather, whatever it is, if their estate value is more than 13.99 million, then the tax rate is applicable. They have to pay estate tax. Only then assets gets distributed. What happens if no estate tax is paid? The executor will be held liable for the estate tax. So that is the reason, very risky job of an executor or personal representative who is handling the estate. So after clearing the tax liability, only has to distribute the assets. Okay, so 13.99 million, remember this limit is important. Fine. These are your estate taxes. Now there are some concepts which you should know. In your estate, while calculating at the net estate value to arrive at the taxable estate, there will be some deductions allowed. First deduction is funeral expenses. So you can deduct from your gross asset. Next is debts when the person is alive. So basically, if the person has liabilities, we will reduce that from the gross estate to arrive at taxable estate. Next, qualified charitable contributions. So if the person has mentioned in his will that you have to give this much to the charity, that also will deduct before arriving at the taxable estate. Political contributions. Last thing is marital deduction, very important. I will explain what it is. Marital deduction. So there is one tax planning available here related to marital deduction. So there is X here, X has ex-wife. Okay. So what ex-wife, so X has died, this is, remember ex-wife should be US citizen, then only this is possible, marital deduction, US citizen. Okay, let's say X estate value is 15 million. So it is more than 13.99 million. The remaining 1.1 million is taxable. 1.01 million, you have to pay estate tax. The executor has to. But there is an option to make marital deduction. If ex-wife is a US citizen, the entire 15 million can be transferred to ex-wife. Okay, to escape the estate tax. So what happens is estate attorneys, so what they will do is till 13.99 million, as it is exempt, they will keep with estate, and whatever excess, so 1.01 million, they will transfer to ex-wife as a marital deduction. So what happens to this 1.01? It will be added to ex-wife's assets. So completely legal. So this actually helps to escape the estate tax. When ex-wife dies, then this will be treated as ex-wife's estate, and if it crosses 13.99 million, then ex-wife's estate has to pay estate tax. So this is what marital deduction, very commonly used in US by estate attorneys or tax attorneys. Okay, so these are the deductions normally applicable for your form 706. There is another concept called unused exclusion. Deceased spouse unused exclusion. Let us discuss this concept. Okay, so what is this concept? Let's say there is a X here, ex-wife is there, X estate, okay, is 8 million, ex-wife's estate is 20 million. Unfortunately, X deceased. As it is 8 million less than your 13.99 million, fully exempt, X estate is fully exempt. But X has limit up to 13.99, which is 13.99 minus 8, approximately 3.9, 5.99 million is unused limit. Unused limit which is going waste. Okay, so this limit can be transferred to ex-wife if she is a US citizen. Okay, so ex-wife, the limit is 13.99 million. 20 minus 13.99 is how much? 6.01 million is taxable estate. But as his husband didn't use 5.99 million, even this will be excluded in calculating your estate. So ex-wife estate has to pay only tax on 0.02 million US dollars. So tax is applicable only on this. This is the concept of deceased spouse unused exclusion. That the exclusion which our limit can be transferred to your spouse, not only wife, even husband also you can transfer. But for transferring you have to file the 706, even though you are not crossing your 13.99 million. That is the only exception. So these very important concepts, I hope you understood. Now let us discuss the last and final concept, which is your gift tax. Okay, in gift tax what happens is the donor has to pay the gift tax. In India, normally donee who receives the gifts will pay the tax, but in US, donor has to pay the gift tax, not the donee. Okay, the limit is 19,000 US dollars per donee. Okay, if donor is giving a gift more than 19,000 US dollars to any person, then he has to pay gift tax. So up to 19,000 US dollars per donee. Okay. So there are 5 persons. You can give 19,000, 19,000, 19,000, 19,000 to each person. Then gift tax is not applicable. Per donee, if it exceeds 19,000 US dollars, then the donor has to pay the gift tax. The gift tax rate is 709. It is only applicable if you are paying more than gift tax return form 709. This is applicable only if you are paying gift more than 19,000 US dollars per donee. The due date is April 15th, same. April 15th for this particular gift tax return. So now, suppose you have given gift to your friend, some $10,000, whether it is exempt? Yes, it is exempt. There is no concept of blood relation in US except for spouse. For spouse, if she is a US citizen, you can give unlimited amount of gift. Only for spouse. Amount of gifts. Okay? For your children you can't give. For your brother you can't give. If it exceeds 19,000 US dollars, it is taxable. Only for spouse who is a US citizen, you can give the gift unlimited amount. So even 1 million, 2 million you can gift to your spouse. Now there is another concept of ununified credit. So what is this concept? So what is this concept of unified credit? I will explain with an example so that you will understand this. Let's say you have given X has given gift to his friend Y 100,000 US dollars. Okay, the limit is 19,000 US dollars, right? So gift tax to be paid on 100,000 minus 19,000, which is approximately 81,000. Not approximately, exact. On this 81,000 you have to pay gift tax. But you can use one more concept called unified credit. You can escape gift tax by combining with the estate. So estate limit we have mentioned now, 13,990,000 US dollars. This is estate exemption limit. So what you can do is you can reduce your estate by 81,000 US dollars. So 81,000 US dollars is how much? Let me calculate. So 13,990 13,990 minus, so it comes to 909 US dollars. Okay, to escape the gift tax you can do like this. You can reduce your exemption limit of your estate, so this won't be treated as your gift tax. No need to pay gift tax in it. The corresponding estate exemption limit get reduced. So how many gifts you are giving in your lifetime, the entire thing get reduced. So upon your death, so if it crosses this renewed limit, new limit, then your estate tax is applicable. So that is the concept of unified credit. You can use it, you can do tax planning based on this after crossing your 19,000 limit per donee. So this is all about your paper 1. So I have completed almost all the topics in a short and crisp manner. For your exams, I suggest you practice MCQs, as many MCQs as you can get, so then you can qualify. So thank you one and all for seeing this course. If you like this course, please subscribe to my channel, like and share to your friends also.